This is an extremely serious economic condition which, on top of rising interest rates, will almost certainly destabilize the whole of the Eurozone banking system and threaten to blow apart the euro itself.
This is Kaiser Johnson with Liberty and Finance, and this is the Miles Franklin Weekly Special for November 22nd through 29th, 2022, while supplies last. This week we have two great ways for you to stack silver ounces: kilo bars from the nadir and Valcambi mints. Our kilo bars are 32.15 troy ounces of silver. Both are 3/9 fine or 99.9% pure, and both are individually serialized by their respective mints. The bars from the Nadir refinery in Turkey are available at $3.50 over spot per ounce, while the Swiss Valcambi bars are $4 over spot per ounce. Both bars are LBMA approved and suitable for IRA storage. And if you'd like to learn more about a precious metals IRA, call us and we'll be happy to help you in that process. Our number for all orders is 1-888-81-LIBERTY. That's 1-888-815-4237. We're available after hours and on weekends, and we look forward to speaking with you. And have a happy Thanksgiving.
Welcome back to Liberty and Finance. We're always privileged to have this distinguished returning guest. Alasdair Macleod is a former bank director and the head of research at goldmoney.com. He joins us this Wednesday, November 23rd, 2022. Alasdair, thanks for coming back on Liberty and Finance.
That's my pleasure, DK.
You've been warning us for a long time now about increasing strains and fragility in the banking system in Europe, in Japan, to some extent in the US, looking for areas of concern, areas of weakness, usually revolving around overextended credit leveraging and the need for banks now to contract their balance sheet in order to, reduce their risk. And you've been warning us that we'll be unlikely to get out of this year without some major rescue needing to be necessary. And it looks like that may have just occurred in the form of a potential rescue of Credit Suisse Bank. Can you tell us what what we can see around the edges, what we're not being told, and what's likely happening?
Yeah, sure. It's a classic case, really. Credit Suisse got itself into a real problem, and that is that there's been a bit of a run on the bank. It was announced, I think, today or yesterday that something like the equivalent of $88 billion had been withdrawn from its balance sheet by customers. Now, I haven't actually looked at the numbers in detail, and I'm not sure to what extent that is bank deposits being withdrawn and to what extent it's deposits being, or if you like, funds being withdrawn from the wealth management side. It could well be that the fund management side banks with the banks. So, there could be a bit of duplication there. But nonetheless, these are huge amounts of money coming out of Credit Suisse. Now, it explains why the Fed has been feeding dollars through currency swaps to the Swiss Central Bank for the last 2 or 3 months. And quite clearly, the Swiss Central Bank has had to come in and lend support to Credit Suisse. So what we have, I think, is evidence of the first global systemically important banks since G-SIBs were invented, now running into liquidity difficulties. This is not surprising, but it's a major event. And I think that as this story sort of gathers pace a bit, I think we're likely to see a lot more commentary about the safety and the security of these mega banks. The problem with them is, unlike local banks, which are sort of restricted within national boundaries in terms of their actions, these G-SIBs spread counterparty risk around the world. So you will see the banking community as a whole backing off from banks which they perceive to be too risky to have as counterparties in the money markets, in derivatives, in Well, virtually everything, really. This, again, leads to accelerating a crisis, potentially in a GSIB. What we're seeing, DK, is a change in the situation where we have falling interest rates, expanding balance sheets, and expanding credit, and everything's lovely and rosy, and credit is easy to obtain. Now it's going the other way, and the first victim of this is Credit Suisse. This is a situation that's going to continue. Now, I know we've got a pause in the interest rate scene. I mean, if you look at the way bond yields have fallen, they've fallen very sharply over the last month or so. That, I think, is merely, if you like, a consolidation in a new trend of rising interest rates. And the reason I say it's rising is because we are moving away from the Bretton Woods dollarization of the global economy into something else. And that something else is more, if you like, commodity driven. I mean, we've seen Saudi Arabia cold shoulder your President Biden last month. It's now said by Saudi sources that President Xi is due to visit Saudi Arabia. Now, this is interesting because only a few days ago, China agreed with Qatar to supply liquid natural gas over the next 27 years. So China basically appears to me to be going around sorting out its energy supplies for the long term. And I think this is why President Xi is actually going to Riyadh. It hasn't been confirmed by the Chinese, but it's been stated by Saudi sources. So, it's a watch this space situation. The reason this matters as far as banks are concerned is that Saudis are turning their back on the petrodollar scene, which they were party to back in 1973. So this is a major development as far as dollars are concerned. So what are they going to accept instead? Well, obviously not dollars or fewer dollars. But when it comes to dealing with members of the Shanghai Cooperation Organization, the Eurasian Economic Union, BRICS, which Saudi is said to be interested in joining, what that means is they'll be getting other currencies. And it's in that context that I think that the discussions between Saudi Arabia and China and Russia, because everybody's involved in this, have really centered around about the, if you like, the quality of the currencies that Saudi is going to accept instead of dollars. Now, I have no doubt at all that the new trade settlement currency that's planned by a committee of the Eurasian Economic Union is going to be commodity based. I mean, we haven't had the details. We've had an initial announcement which didn't tell us much other than very general terms. But the analysis that I've done on this situation suggests very, very firmly that actually what they should be doing is not messing around with a basket of currencies and a basket of commodities and so on, because that's going to make it very difficult for anyone else to join in. What they should be doing is just quite simply having a currency which is notionally fixed to the gold price. So on that basis, Saudi Arabia could accumulate reserves in this new Eurasian trade settlement currency. And guess what? Of course, the other thing we've had is that Moscow has set up a new physical exchange in Moscow using an Asian standard, which I guess is going to be the Chinese 49 standard, kilobar standard, so that the infrastructure, if you like, for the whole of the Asian trade bloc to settle its trade between themselves and between other parties in gold-related currency, I think that is very much underway. Now, where this leaves the Western banking situation is that for a start, there's likely to be an outflow of dollars. And I just wonder to what extent the fall in the trade-weighted index in dollars recently has been partly due to the beginning of a run on the dollar. We have certainly seen that China and Japan have been reducing their investments in US treasuries. What we don't get in terms of statistics just yet is any reductions that they've done in other financial investments in dollars and, if you like, US domestic dollars. So things are beginning to sort of move, I think, quietly underneath the surface. And to my way of thinking, the effect on the dollar will be to drive it down in the foreign exchanges, certainly against commodities, which is the important thing. Right? I mean, we can guess what's going to happen against other currencies. I mean, that's, they're all in the same boat, basically. But what I would see is a weakening dollar against commodities. Now, what that means is that the idea that inflation is going, prices are going to return to 2% or something like that, that's just for the that's for the birds. It really is. You're going to see persistent price inflation at all levels, from commodities through wholesale prices through to consumer prices, irrespective of whether the US economy, our economy, the Eurozone economy is in recession or not. And what this means is that that's higher counterparty risk for the banking system. It means that the customers to whom they have lent money, in the physical economy, Main Street, if you like, a lot of that is going to turn into bad debts. It means that bond yields will rise, which undermines the value of the collateral that banks have on their balance sheets. So that's something they're going to want to get rid of. And the only way you get rid of collateral basically is by foreclosing on loans. So you can see that the situation is beginning to work rather against the Western financial system. And I would make a further point, and that is that virtually all transactions measured by GDP are settled in bank credit. There's only a very small minority which is settled in non-bank credit, non-commercial bank credit, and that's cash. Probably less than 5%, I should think, easily less than 5%. So what really matters is what happens to that bank credit. And if you get a contraction of bank credit, then you're going to get a contracting GDP. And what do we call contracting nominal GDP? We call it a recession. It's not necessarily a recession. It's a contraction in the amount of credit in the economy. And so on that basis, they're going to be screaming recession. Of course they will. But really what's happening is you've got bank credit contracting, and it's because bank credit generally has expanded so much since the Lehman crisis. That contraction is not going to be trivial. It really is not. So I'm afraid that the outlook for Western financial centers, commercial banking, is one of increasing risks. I think Credit Suisse is the first rescue. I think there will be more. There are certainly other banks which are at least as highly balance sheet leveraged, if not more so. Particularly in the Eurozone and also in Japan. And a lot of those banks have price to book values at very substantial discounts, very substantial. And when I say discounts, I mean like Credit Suisse on the share price fall we have seen today, which has taken it into new low ground. I'm guessing slightly, but I think the discount to book value is about 80% now, 80%. Now, that's just option money on the survival of the bank. The rights issue is not going to guarantee its future. It really is not. And as far as other banks are concerned, we've got other banks which are similarly afflicted by massive discounts to book value, which is the market's way of telling us that the market reckons that these banks are all but bust. So, I think contracting bank credit will expose that position to us. And you're going to have central banks working very, very hard to catch a failing banking system, commercial banking system, to ensure that depositors are protected. So that's roughly where we are. And I think that this Credit Suisse news is, I'm afraid, the first of several that we're likely to see in the ensuing months.
If you'd be willing to indulge us with a little bit of a closer look at the Credit Suisse unwinding. You are a former bank director, as I mentioned earlier, and have some insights into how things work within banks in terms of the positions that they take and the leverage that they have to try to employ in order to make their profit in different rate environments, et cetera. But it might come as a surprise, it certainly does to me, and may be to many people, that Credit Suisse, I mean, it just sounds, knowing what you know about Switzerland, it's a high average income country. They've got high savings rate. They've got a comparatively stable social structure and cohesive society, that sort of thing. So why it doesn't seem to be a poster child of profligate, running around making wild bets or something like that on the part of the bank. So do you have any insight into what got Credit Suisse into so much trouble that there would be, like, what would have triggered a run on the bank in the first place? And secondly, that would have necessitated a bailout or a rescue from the Fed?
I think the first thing I would say is that the fact that Credit Suisse is a Swiss bank located in Zurich, I mean, it's better understood as an international bank rather than a Swiss bank. The Wealth Management Division certainly manages funds on behalf of Swiss residents, but a lot of the funds that they will be managing will be for international residents. The one exception, I think, probably is American residents, for the very simple reason, and American nationals, because of the complications of complying with American regulations. There will be basically three divisions you need to think about in that bank. One is basic banking, and that is, they say deposit taking, but it's basically the creation of loans and therefore the creation of deposits. Now, most of that business would be the deposit creation would effectively be domestic, but the ownership of those deposits would morph into more international hands. So I think that's the first side. I'm not sure that the 88 billion, quite where that emanates from. The way it's worded would make one think that it's a reduction in deposits. In other words, a flight of money out of the bank, classic run on the bank. And that certainly makes sense because if you like, the reputation of the bank has taken some very, very serious knocks. We've had sort of very public big losses and big mistakes, big lending mistakes. Now, and also they've been fined by the authorities for various actions, as have other GSIB banks. So there's nothing unusual in that. But I think the thing that has probably knocked confidence in the bank more than anything else is the scandal over the bank spying on former employees. Literally spying on them. Trying to establish whether they're taking secrets to other banks or whatever. And I think, if I remember correctly, even spying on current employees, well, at the time. And that sort of behavior is not the way gentlemen behave. Now, the reason I use the phrase gentleman is because Credit Suisse was always seen historically as the gentleman's bank, if you like, compared with UBS, which was a bit sort of nouveau riche, if you like. I'm sort of being, maybe economical with my description, but I'm trying to just get that idea across that they were the blue chip of Swiss banking. So when you get a scandal of management behavior like that, and signs that the management itself is rotten as management, which is really what it boils down to. And any management that does that and gets caught doing it is obviously, pretty rotten management. So you can see how the confidence in the bank is diminishing. Their balance sheet, as a result, has actually been diminishing, not just now, but for the last 2 or 3 years. So that, if you like, is an indication of a rather sick bank in terms of its pure banking business. The other two lines, one of which is obvious, and that is the wealth management side. Wealth management, they have been losing funds. Wealth managers have had a real problem insofar as they've seen bear markets now. This year, they have seen losses, particularly in US investments, and you'll find that quite a lot of the investments in the wealth management portfolios will be in US equities. Of that I'm sure. So there have been significant losses there. And of course, fund managers, I mean, they're just like you and I. They follow fashions. And you could see quite easily that they would have got stuck in the Apples and the Alphabets and the, all those high-flying stocks which have now crashed. You've also got, I mentioned one of the smaller ones, the corporate division, and that has really suffered. I mean, the amount of business that they've managed to win in terms of M&A and all the rest of it has been really pretty minor. And I think that's partly due to the bank's reputation. I mean, people would rather have, let's say, Goldman Sachs handling their merger or their acquisition or advising them in a takeover than, say, Credit Suisse. I mean, I'm not running down the abilities of the corporate division. It would be wrong to do that. It's just, a corporate division in Credit Suisse is going to be running at a pretty large disadvantage compared with corporate divisions in, I say, Morgan Stanley or, any of the major American banks, or even UBS, which has got a far more sort of proactive, aggressive, go-get type approach to life. But I think one of the principal divisions, which has been highly valued in the past, but now I think has lost quite a lot of value, is the derivative origination division. And I mean, as I think I've said on your videos before, one of the problems with derivatives is that they grew from virtually nothing to there's a notional $600 trillion equivalent as far as the Bank of International Settlements figures say at the end of last year. And that's grown really on the back of declining interest rates. I mean, a long-term trend of declining interest rates is really what is behind that expansion from virtually zero to 600 trillion. It's also, incidentally, behind the expansion of futures markets, regulated futures markets, which are currently around about 50 trillion. So now that we've got an environment of rising interest rates in Western currencies, and particularly the dollar, that is contracting. You've also got the problem of Basel regulations, which basically mean that a bank which runs derivative positions in most circumstances is going to be using its balance sheet inefficiently. So when a balance sheet is under pressure, one of the first things that you're going to want to cut back as a chief executive of a bank is your derivative exposure. So you can see that there are a number of things that have come together that have made Credit Suisse's life really rather difficult. But to my mind, the one thing which probably tops the lot has been the destruction of management credibility. I think that really is important. I mean, it's not for nothing. You remember in the old days when we actually had bank branches. What would your bank branch look like? I mean, it'd be a huge, great building, with sort of Greek and Romanesque pillars and, a doorman opening the door for you and all this. I mean, the bank, I mean, for goodness sake, this was to impress you about its wealth, about its foundation, about its strength. So this is the importance of management in a bank. And if the management in a bank is found wanting, it doesn't take very much to topple it over. And that, I think, is the fundamental problem that Credit Suisse faces. There are other banks in Europe which are facing the same problem. But so far, it hasn't really surfaced as publicly as it has with Credit Suisse. I mean, some of the French banks are very much in that position with asset to equity ratios of well over 20 times. In one case, I think it's about 27 times. Deutsche Bank is another one, which everybody knows has been, it's had a number of troubles going all the way back for the last, well, certainly back to the Lehman crisis, and more specifically during the Eurozone crisis, which was 2013-14. So that's had to retrench, and it's got through quite a few chief executives in the process. All has gone quiet on that front, but it doesn't mean to say that problems have gone away. And contracting balance sheets undermine the weakest. And that's what we face, I'm afraid.
You mentioned in the past the weakness of the euro itself and strains structurally in the eurozone between countries with completely opposing priorities. We're talking now about banks and their balance sheets and that sort of their risk of their banking operations, et cetera. What about the euro itself and the eurozone itself? Can you bring us up to date on that?
Yeah. Well, I mean, the euro has been very weak. It ran down, I think, to something like, sort of under $1, 98 cents, I think, for a euro. It's now bounced back up a bit. It's about 105, something like that. We've got a general rally in these currencies, which, as much as anything, is due to two factors. Firstly, the immediate pressure from rising bond yields seems to have lessened. And secondly, we have that reaction in the dollar, which is just making the other currencies suddenly look a bit better. The problem with the euro is that it's a manufactured currency. It's not like the dollar. It's not like sterling. I mean, those currencies, have a history behind them. Going way back, they were substitutes for gold. I mean, you could take your dollar along and change it for gold. I mean, literally, we could do that with sterling. Now, somewhere in the very, very far distant memory, that is the linkage that we still have today, even though the dollar's lost 98% of its value measured in gold since 1971. But that sort of link still persists. The euro does not have that link, so it's got a fundamental problem when trouble arises. As to what's likely to happen, I think the political scene in Europe, as always, is extremely difficult. And here again, I think what we've got to do is to try and think it through in this new environment of rising interest rates. The euro has held together over a period of falling interest rates, even to the point where negative interest rates, negative deposit rates have been imposed by the ECB. So that period has now ended. We now have rising interest rates, and we've got to think in terms of the effect on the target 2 imbalances between the national central banks. And we've also got to think about the effect on the repo market, which in pure euros is around about 6 trillion of about 9 trillion euro repos around the whole of Europe. Now, 6 trillion euros of repo is a not inconsiderable sum. The banks have been using this as to get cheap liquidity, in effect, on their balance sheets. As the cost of repos rise, this is going to undermine the liquidity situation in general terms. The other problem we have, and this has also been already admitted by the Dutch National Bank, and that is that they are already running into negative equity because of the quantitative easing bonds which are on their balance sheets. The bond yields have risen and the value of those bonds have fallen, and it's wiped out the equity in virtually all the national central banks. Now, obviously, that situation has, lessened with the fall in bond yields recently, but nonetheless, this is still a problem. What the Dutch National Bank said is that, we don't actually have too much of a problem with this because we can always revalue our gold reserves, which is an interesting statement because it really means that there is, if you like, a balance sheet use without disposing of their gold reserves, even maybe they should increase their gold reserves. Their gold reserves are probably the best asset they've got on their balance sheets, and by God, they better hold on to them. I think that's the message that we're getting, if you like, through that simple statement. But it does confirm that these banks really do have a problem, and they are beginning to think about it. I'm talking about the central banks in this case. And the reason this really matters is in the Eurozone is that we expect a somewhat dysfunctional Euro system to backstop an extremely highly leveraged commercial banking network. And this is something which, particularly with the winter coming on and higher energy prices in particular, higher food prices hitting Europe. I mean, these are going to hit Europe a lot more than America, I can assure you. This really does mean that we're going to be moving into a deepening crisis in the winter months. Now, how are the banks going to survive this? How are the central banks going to survive it? Can the central banks just bluff their way through it? Well, that's a very risky bet, I would suggest. So what we're looking at, I think, is a situation coming back to the political angle, which has moved from, we can disagree and I can shout about you and you can shout about me and all the rest of it, but don't worry, interest rates are falling and we'll get cheap money. So, we'll put off our problems. That's changed because the cheap money isn't there anymore. How is that going to affect the politics between, say, Italy and Germany, France and Germany? Germany is, its economy is in freefall, absolutely freefall. And it's been brought about by the politicians. The politicians are saying, we're not going to do business with Russia. No, Russia was a major, major market for Germany. And where they're supplying other goods into the Eurozone, their customers, we're talking about the Mittelstand. Companies like, sort of automotive component manufacturers, like Bosch, for example, their customers are businesses all around Europe, and they, in turn, are affected by this ridiculous situation of trying to sanction Russia. This is an extremely serious economic condition, which, on top of rising interest rates, will almost certainly destabilize the whole of the Eurozone banking system and threaten to blow apart the euro itself, because it does not have that reference back to having been a currency with a long history, going all the way back to some stage in the past where you could exchange it for gold. So it is an inherently unstable situation with a currency which is unlikely to survive, or certainly less likely to survive than its peers.
Well, you brought it up first, is government action or government causing trouble? And I wanted to expand that discussion further because we've seen over the past 2.5 years sweeping government action, sometimes by most of the governments of the world in concert, that have had drastic effects on economies, businesses, travel, you name it, freedom all over the world. And this seems to be happening on a recurring chronic basis. Like you can't even catch your breath for the first crisis before the next one is upon you. And the pattern that people are starting to see is that it's like the line from The Wizard of Oz where Dorothy steps out of the crashed house after the tornado and walks out and says, I don't think we're in Kansas anymore. It seems like we're not in the world that we all grew up in, that our parents, our grandparents, our great-grandparents grew up in. It seems that the world, for some reason and by some powers other than the ordinary people, has been forever changed into a world where we can expect this never-ending drumbeat of crisis after crisis after crisis, all of which seem to be necessitating, if you believe our governments, huge government action and intervention, almost always resulting in further loss of freedom and increased scrutiny and control and surveillance and that sort of thing. You've started some writing about this, and I know without getting too political, if you could touch on it from the standpoint of an economist, from the standpoint of someone who looks at the financial impacts of this, what you're seeing in terms of this compulsion of governments to basically ruin things and say that, well, you have to let us do this because it's for your own good.
Yeah, I mean, I think you put it actually quite well. The problem comes down to a question. We have democracy. Now, what sort of democracy do we have? And the answer is it's not pure democracy at all. It's, they call it in Europe social, the social democrats. The parties are social democrats, for example. We're all social democrats. I mean, I'm talking about governments rather than as individuals. And what that means is that we take wealth where governments take wealth where they can find it in the economy, take it into the government and redistribute it. The whole basis of socialism is the redistribution of wealth. Now, what this has done is it's created a situation where governments are not acting for everybody. They're acting for certain, if you like, groups within society, and particularly sort of socialist groups and groups that associate themselves with socialist groups. Whereas, I mean, I think the best example of this was the kickback when President Trump got elected. I mean, the Democrats described the people who voted for him as what do they call them? Deplorables. That's it. Thank you. What a thing for a politician to say. I mean, these deplorables are just the ordinary people who basically don't go around shouting about this, that, and the other thing, but getting on with their lives. They are the small businesses in Middle America. They are, just normal people who don't have too much interest in politics and would rather the politicians just left them alone. So we have this lopsided situation where the majority of people are no longer represented by their governments. And the distortion that has come with this is instead of governments, through democracy, being the servant of their people, they are now the masters of their people. And they cement this through international relations. I mean, when you look at G20, G7, World Economic Forum, when you look at OECD, you look at all these operations, and what are they doing? They're all reinforcing their social democratic credentials, all interfering in everybody's business to achieve their own objectives, not the electorate's objectives, but their own government objectives. And that's where it has all gone wrong. Now, they have distorted markets so much through this. And, I just look at interest rates, look what they did with interest rates, driving them down to zero. I mean, that's just nonsense. And driving them into negative territory. I mean, this is unnatural. It is not right. So having created all these distortions, now we have a situation where the markets are beginning to take charge. And the problem for the politicians is that suddenly when they pull the levers of power, nothing happens. Nothing happens. I mean, in this country, we've got something called the National Health Service, which is the most expensive waste of money you can possibly imagine. I do not criticize the people who work in it, particularly on the front line, because they are dedicated, they work damned hard, they work long hours, and they're there, if you like, for a vacation as much as for an income. I mean, these are wonderful people, but it's the system which is rubbish. And what happens from the political end is the politicians will allocate another 20 billion, say, to try and improve the National Health Service. And how much of that gets down to the patient? I can tell you, zero, nothing. The system does not work. This is very frustrating for the politicians. And you've got the bureaucrats who increasingly, I mean, they produce all the regulations. And I mean, the point is that they're getting involved in areas of business for which they have absolutely no expertise. And so they are hampering business. And now you find that business is not responding in the way in which the politicians would like. Why? Because they're absolutely up to here in regulations. They can't respond. They're strangled. They're suffocating. They're drowning. And so this is interesting because, I mean, it's interesting. It's rather like, watching a man go through his death pains on a scaffold. I mean, it's that interesting. That sort of peculiar interesting. But when I compare this with history, I mean, to me, the best comparison as to how really government should run was under Lord Liverpool, who was Prime Minister in the in the second half of the Napoleonic Wars. He had Wellington as his chief of the army, who he developed a very good working relationship with, and so there was a successful campaign on the continent, and they defeated Napoleon eventually at Waterloo. But also, he had as a foreign secretary Castlereagh, and the policy in those days was not to interfere with other people's domestic political affairs, however you may agree or disagree with them, but only to protect British interests. What are we doing now? We're telling China, stop torturing the Uyghurs and all the rest of it. It's not our business. It really isn't. I'm very sorry for anyone's harm, but I mean, for goodness sake, we've created enough harm. We're hardly in a position to preach to the Chinese. And Liverpool himself was no mean understander. He understood economics. I mean, enough to actually set the country on the right course. We came out of the Napoleonic Wars with prices rising at something like, they had risen, I think, from before by about 50 to 60%, from when the gold standard, or rather it was a silver standard officially, but it was really gold, had been suspended in the 1790s. The level of government debt had risen to an estimated 250% of GDP. Not that GDP was calculated in those days, but that's what we're told. Anyway, there was a hell of a lot of debt around, and he got it down. I mean, by continuing with sound money policies, rather than trying to inflate it away. By the First World War, when the gold standard ended, British debt was down, government debt was down to 25% of GDP. This is the way to run a government. And the fascinating thing is that Liverpool was really driven by a concern of managing the state for the benefit of everyone, not for the benefit of his supporters, not for the benefit of sort of weird groups, woke groups, or stop oil groups, anti-fossil fuel, whatever. No, didn't do that at all. He did his best to balance the interests of everyone. So I think there we have a template as to how government should be run, and unfortunately, we cannot be farther away from that than we are today. I mean, it's just completely different. So there we are.
You mentioned the conflict of interest that governments are exhibiting as far as not serving the good of the people. That's becoming more and more evident to those who are being observant in any way. It's just like, if you wanted to do a series of actions that were directly against the interests of the people, you would do precisely what the governments have been doing for decades and decades. You didn't mention this quite this way, so I'll add this to what you were saying. It's not just supporting special interest groups and picking winners and losers and supporting certain woke factions or so on, but it's always increasing and cementing the power of the state itself. So in other words, we're not going to do what's good for the people, we're going to do what's good for the state, and those who will sign on and basically sign away their virtue and instead just do whatever they're told, those will be rewarded. And therefore, the state just continues to monotonically increase its power, consolidate its power, and become more and more intrusive and control-oriented towards everyone's life. So we're on the receiving end of that as the people, and we look to you and others of our guests to help us have clear sight of what's actually going on so that we can position ourselves accordingly. And we're grateful always for you giving these updates on how things are progressing, because it's very hazardous, I believe, for people to fall into normalcy bias and just think, well, nothing's happened yet. So we're just bumping along. And it's like, no, folks, the wheels are in fact wobbling and starting to get ready to fall off. And sometimes you can see that they're trying to nail the wheels back on again, even as they're falling off as we're going down the road. So, Alasdair, if people want to follow your work, because you write quite a bit each week, where should people get connected?
Yep, Gold Money, and if you want to open an account, I'm sure that we would love to see you. So go to goldmoney.com and hit the research tab, and every Thursday I publish a new article, which comes out sort of midday or early afternoon Eastern Standard Time, and I do a market report on Friday, which comes out at about the same time of day. So that's basically my output.
And folks, you may have heard this before, but maybe you didn't do anything about it yet. If you don't want to miss a single episode with Alasdair as soon as it comes out, and you don't want to miss it, make sure you go to libertyandfinance.com. That's libertyandfinance.com. Put your name, your email address, click submit, and make sure you confirm on the confirming email you will be opting into our once-a-day free email list, and you'll get a link to every interview we do with Alasdair, as well as all of our other guests and any specials that we have. One email per day delivered to your inbox to keep you up to date, so you won't miss a single notification. Alasdair, on behalf of all of our viewers, we're so grateful for your presence here on Liberty and Finance.
That's very much my pleasure, DK.
Miles Franklin Precious Metals is one of America's oldest and most trusted bullion dealers. Miles Franklin is A+ rated and accredited by the Better Business Bureau, licensed and bonded, and has 0 complaints ever registered. Here at Liberty and Finance, we are licensed brokers with Miles Franklin. To order, simply call us, discuss your needs, and we will let you know our live inventory, prices, and availability, and lock in your order over the phone. Once your order is locked, the price is held for you regardless of market fluctuations, and the metals are reserved for you awaiting your settled payment. Within 1 business day of ordering, you will receive an email invoice detailing the order and payment instructions. Miles Franklin accepts payments by bank wire, ACH or electronic check, money order, check mailed priority mail, and cryptocurrency. The fastest forms of payment are bank wire and cryptocurrency. Upon settled payment, metals will ship out within 3 to 5 business days. You will receive tracking information via email. Domestic shipping charges are $15 for any order under 500 ounces of silver or 10 ounces of gold. For orders larger than that, domestic shipping is free. The package will be double boxed, fully insured, and labeled discreetly, with no indication of the contents inside. For your privacy, the name Miles Franklin will not even be on the package. To talk to myself, Elijah, my brother Kaiser, or my father Dunnigan, call 1-888-81-LIBERTY. That's 1-888-815-4237.